Why I sold all my 3M company shares and should you do the same. After years of being a 3M shareholder, I finally decided to sell the stock, and in this video I will tell you what exactly led me to that decision. And if you don't have 3M in your portfolio but are wondering whether to buy it, I hope I will help you make a more educated decision. Hi, my name is Ognjan and welcome to the Dividend Method channel. So let's not waste any time. Here is my plan for the video. I will first make a very brief overview of 3M company. Then I will explain my reasons for purchasing the stock and holding it for years. After that, I will briefly describe the problems that the company has, and then I will tell you my reason for selling it. Let's start with a brief overview. 3M company is an American multinational industrial conglomerate that produces over 60,000 products in four main segments: safety and industrial, transportation and electronics, healthcare, and consumer products. Some of their well-known brands are Post-it, Scotch, and Nextcare. 3M was founded in 1902, so it's over a century old. The original name of the company was Minnesota Mining and Manufacturing Company, hence the 3M name. Now, why did I decide to buy the company in the first place? Several years ago, when I was screening for stocks to buy, 3M came to my attention because of the unusual combination of a stock with a relatively high yet fully covered dividend yield. Of course, those who know about my work and the principles I teach inside the Dividend Method program know that one of the worst decisions you can make is to invest in a company just for their high yield. So of course, after the initial screening, I started doing more due diligence and was quite impressed. First, the company is a dividend king. The dividend kings are a small elite group of stocks that have increased their dividend every year for at least 50 years, which is an extraordinary achievement. This means that the company has a solid business model, great management, a wide business moat, and has been able to navigate multiple difficult economic times that include inflation, deflation, depressions, recessions, etc. Companies in that list include Procter & Gamble, PepsiCo, Johnson & Johnson, Altria, and others. So of course, every company that has this status naturally draws the attention of any dividend investor, and in general, these are great businesses that you can start your research from. 3M in particular has increased its dividend every year for the last 64 years, which is extremely impressive. If you're not sure what exactly the company does, well, it's not your fault, because their products touch everything in our modern life. They have tens of thousands of patents and very strong and innovative research and development teams. Just to give you guys a brief idea, 3M has a presence in abrasives, safety protection equipment like helmets, masks, and earplugs, in the dentistry and other healthcare sectors. They make the Scotch tape and your favorite sticky notes. They produce paint, and the list goes on and on and on. They're just basically everywhere. So that was one of the reasons why I purchased the company in the first place. Their products literally are part of the physical infrastructure that our civilization is built on. Of course, I went through a deep fundamental analysis using a lot of metrics before purchasing it, but that is not the focus of the video and is a topic for another day. So now you might ask, if the company is so good, then why did I sell it? Here we get into the problems the company has. I will first talk about the lawsuits and then go over some financial metrics that are concerning. You definitely will want to hear that because it will show you how to not fall for the trap of some dividend kings or aristocrats, which is what happens to a lot of new investors. First, the huge, ugly elephant in the room, the lawsuits. 3M has been involved in two major lawsuits that have been haunting the company in the past years. First one is the combat arms earplugs. 3M supplied the US military with earplugs that were supposed to protect soldiers from loud noises because, well, when you're in the middle of a battle with rifles and bombs exploding all over the place, there is a lot of loud noise, but allegedly failed to do so, resulting in hearing loss for thousands of soldiers. 3M faces more than 230,000 individual lawsuits from plaintiffs seeking compensation for their injuries. Now, I knew that when I was buying the company and was okay with that because I realized that this is one of the main reasons why the price is depressed and the yield so high. So I simply put 3M in a bit of a riskier category in my portfolio. The estimates of the cost of the lawsuits I have read are so wild that they are not even useful. I have literally seen range of $1 billion, which would be totally fine, up to $100 billion, which will wipe out the company. No one knows how this will progress in the future, and the dark clouds of the lawsuits are still hanging above the company. The second lawsuit is the PFAS chemicals, also known as forever chemicals. 3M produced chemicals that are used in various products such as firefighting foam, non-stick cookware, and stain repellents, and these chemicals have been linked to health and environmental problems such as cancer, liver damage, and water contamination. 3M has faced lawsuits from state municipalities and districts and individuals who claim that the company knew about the risks of PFAS chemicals and failed to warn or protect the public. In a minute, I will discuss a bit more about that lawsuits because it was the final nail in the coffin that prompted me to sell the company. Before that, just a quick look at the financial metrics that I was following that were a bit worrying. Here is a chart of the levered free cash flow of 3M in the past 10 years. This metric shows the free cash flow of the company after they have paid all financial obligations. Not looking great. In the past 10 years, the levered free cash flow has been flat to slightly down. Now, there are other companies with similar looking levered free cash flow charts, and there could be many reasons for that, so you never want to base your opinion on only one metric. I knew that when I was purchasing the stock, so I was just keeping an eye on it. Another metric that I was tracking that caught my attention was the normalized net income, which I like to use to see the trends in the profits of the company while smoothing out one-time events. You can see the nosedive in the past few years. Definitely not looking great, especially if you check the year-on-year metric. The last metric I will talk about is the most obvious one, the dividend growth rate. If you want to avoid a common trap for new investors when they invest in Dividend Aristocrats or Dividend Kings, it is absolutely vital that you check the growth rate of the dividend. These companies are able to keep their aristocrat or dividend status by increasing the dividend every year. Generally, this is a good metric that shows that the business is doing great. However, what a lot of new investors don't realize is that the criteria can also be gamified. It doesn't matter if the company raises the dividend with 20% or with 1 cent, it still counts as a raise. And so, some companies which are in trouble will simply raise it by a few pennies to keep their status because it counts as a raise. When you see that, either run for your life or do a deep dive into what is going on, because it usually signifies that the underlying business can't support bigger increases because it is not profitable enough and the company is desperate to not lose its aristocrat or king status. With 3M, the increases are not exactly with 1 cent, but the trend is worrying. In this ugly screenshot, you can see how the growth has been declining across every period we are looking at, from the 10-year all the way down to the 1 year, with the recent periods, the 3-year and the 1 year, having less than 1% dividend increases. Alright, so all of these issues, the 2 big lawsuits and the financial metrics were worrying to me. So I moved the company to a higher risk part of my portfolio and was keeping a close eye on it. The straw that broke the camel's back for me and which made me sell 3M was the following event. Before that, just a quick reminder, if you like this video so far, please let me know by destroying the like button and also subscribing to the channel by clicking the notification bell. And if you don't like the video, well, that kind of sucks and I'm not sure what exactly to tell you. Anyway, so the reason I decided to sell the company was the following. In June 2023, 3M reached a $10.3 billion settlement with a host of US public water systems to resolve water pollution claims tied to the forever chemicals we already talked about. The money will be paid over 13 years. Now, there are 2 very important details that you have to pay attention to here. First, the settlement does not mean that no one else can sue the company for the PFAS chemicals anymore. There are still other lawsuits pending against 3M from individuals, states, and other entities that claim personal injury, property damage, or natural resource damages from the forever chemicals contamination. These lawsuits are not affected by the settlement. The settlement also does not prevent future lawsuits from public water systems that discover PFAS contamination after the settlement date. That means that there could be potentially billions of dollars more to be paid by 3M related to these chemicals. Now, with that in mind, we move to the second important detail you absolutely need to pay attention to. It gets a bit technical, but please bear with me because it's important. I assume that if you want to invest in 3M, you are likely doing it for the dividend, just like me. So, I ran a quick calculation to see how that $10.3 billion settlement might affect the dividend payments. What I did was I divided $10.3 billion by 13 and got $792 million. This is roughly what it will cost 3M per year for the next 13 years to pay the settlement. Then I went to the cash flow statement and calculated that the dividends paid out for the past 12 months were 3 billion and 344 million. The levered free cash flow, which is basically what funds the dividend for the same period, was 3 billion and 498 million. So already the dividend was 95.5% of the levered free cash flow, which is concerning in itself. The company only covered the dividend with $154 million for the past 12 months. When you add the $792 million it needs to pay every 12 months for the next 13 years, it already makes the dividend unsustainable. Yes, at the time of me analyzing it, it had almost $4 billion of cash and cash equivalents, but that still would not cover the costs. And remember, this is not the only case against the company, and 3M still has hundreds of thousands of army veterans suing it for ear damage. When I saw that, I said to myself, that's it, I'm out. They either have to take a huge amount of debt to pay these lawsuits and settlements, or suspend the dividend, or grow their free cash flow like mad in the next years. Here's the important part of understanding fundamentals and why I stress that to all the people I teach investing. Remember the earlier metrics we looked at? Not only is 3M not doing great when it comes to their net income and free cash flow, but they're actually going in the wrong direction. Yes, there have been temporary headwinds from the China lockdowns, currency fluctuations, etc. But having in mind the amount they have to pay just for that one settlement, the pending lawsuits and their financial situation, I still don't think removing these headwinds will change the company's situation dramatically. Now, of course, nothing is certain. We can only work with probabilities, and there is a chance that 3M will manage that crisis they have on their hands and perhaps discover some new substance or material that will be a breakthrough and will make them billions of dollars, which is actually something they have been historically good at. It is possible. But for me, the odds against a good outcome were too much, and the dividend, which was my main reason for investing in them, was in too much danger, so I decided to sell. What happened with 3M and my reaction to it is a great example of what you need to do as an investor. I'm absolutely not sorry for investing in the company. It had and still has great qualities, stellar history, and products that we all need and use. But remember, as investors, we need to be nimble. You should never marry a company or an idea and be blindly optimistic about it. At the time of investing in the company, no one had any idea how the lawsuits would play out, so I did not make a mistake. But there is a great quote that I live by. When the facts change, I change my mind. What do you do, sir? When a company thesis breaks, you need to get out. In order to do that, you need to have an understanding of the right financial metrics to look at and also have a system for evaluating the stock and getting accurate information on it. If you would like to get help with that, then this is precisely the reason I created the Dividend Method program. You can check more about it in the link in the description. Also, if you would like to see my top 4 favorite stocks for the current environment we are in, you can get the free report which will be sent directly to your email. That report will be up to date regardless of whether you watch this video years from now, because I am constantly updating it. Again, the link is in the description. Lastly, please have in mind that all the opinions expressed in this video are just my opinions. I'm not saying whether you should or should not buy or sell 3M stock or any stock for that matter. This is not an investment advice or recommendation, and I don't know your personal situation, so please do your own due diligence. And with that, thank you for watching, and I'll see you in the next videos.